Hey everybody, I'm Michael Kane, your home purchase expert, mortgage broker with C2 Financial, here to give a very detailed overview on what a purchase summary looks like with closing costs. This is a question I get asked about 10 times a day, so let's get started on a detailed overview. The very first fee, lender fee. It does vary from lender to lender, but on average it should be about $1,000. What is a lender fee? A lender fee is the charge that the lender imposes for general processing and administration of the loan. So it can go to pay processing, it can go to pay underwriting, or just general operations. Number two, appraisal. Appraisal typically costs about $500, and that's gonna pay that third-party appraiser to go to the property to make sure that you're not overpaying or underpaying for the property. It's there to protect you, and it's there to also protect the lender/investor. Number three, your escrow/settlement company. Typically, it's gonna be about $1,600. The escrow company is gonna act as the third-party intermediary between the transaction. So they're actually gonna pay off the seller's loan. Us as the lender, we're gonna wire our money there. So they're the settlement agent. So for their $1,600, they're acting as the kind of transaction middleman between the buyer and the seller and us as the lender. Number four, title. It's typically gonna be about $1,200 to $1,500 for a transaction here in California. The title company is gonna insure the title on the property, making sure that nobody in the future can come after you for unresolved debt on that property's title. So things that can come up that they're insuring against would be a repairman that did work on the property for possibly the seller and they never got paid, so they're coming after a lien position on the title. So it's there to protect you and also making sure that there's no encumbrances on your property or people encroaching on your property line. So they're gonna do that title search, and they're also gonna protect you against any future claims against that property. Hey guys, we're getting through this list here really quickly. We're here on number five, recording fees and transfer taxes. Now this does vary from different places within the state of California. Every municipality might be a little bit different. On average, I would say about $400 or $500. Here in my market in San Diego, recording fees on a $500,000 transaction for the state and the county are typically $400. All right guys, we're winding down to the last three items, and they really are some of the more complicated items. It's your prepaids, or basically prepaying your bills or having the money set aside to pay your bills in the future of becoming a homeowner. One, that is your homeowner's insurance. So a homeowner's insurance policy is to protect your house against any claims. Just like if you were to buy a car and you were to drive it off the lot, you need to have car insurance. Same thing goes for your home. So you pay for that policy at closing for a year. So if you close on July 1st, 2020, that policy is good for July 1st, 2021. So that is considered a prepaid. It is a closing cost. On a $500,000 house in San Diego, typically that's about $1,200. Next up on that list of prepaids, property taxes. Property taxes in California, the annual bill is divided into two separate payments. That first payment is due December 10th, that second payment is due April 10th. So when you're buying a house, you basically need to set some money aside to pay that bill when it comes due. So if you're buying in November or October, a few months down the line, you're gonna have a property tax bill. So you have to set aside 6 months to pay that semi-annual tax bill. So it is considered a prepaid, it is considered a closing cost, but you're really just setting money aside within the mortgage transaction to pay your property tax bill when it comes due. And the final item on the prepaids is your prepaid interest. This one's a little bit more complex, so I'm gonna break it down pretty detailed here. So say for example, you're closing on July 15th. You don't just get to live in the house from the 15th to the end of the month or the 30th for free. You have to pay prepaid interest on those days. So if you were to close on the 5th, you have 25 days. If you were to close on the 30th, you have 1 day. Now mortgages are paid in arrears, unlike rent. Rent, you were to give your landlord rent for July on July 1st and you're good until the following month of August. Mortgages are paid differently. You pay them in arrears. So you actually pay July's mortgage in August and August mortgage in September. So if you were to close on the 15th of July, your first mortgage payment isn't due until September 1st because you would pay the 15 days prepaid interest to round out the end of the month in July. If you closed on the 15th, you live in the house in August, and then your first mortgage payment is September 1st. Hopefully that makes sense and I broke it down clearly for you. Hey guys, so that pretty much finishes off the list. Hopefully you learned something, and to give you an example, that's usually about $10,000 or about 2% of the purchase price. The example that we ran through today was about a $500,000 purchase here in Southern California. We know that was a lot of information to take in, so if you have questions, don't hesitate to reach out to the Contact information listed below. I'm always available, always working. Again, this is Michael Kane, loan officer with C2 Financial here in Southern California.